Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, let's start off the show by talking about last week's pairs trade in Pioneer Foods and ZED, because I think there's also a little bit of confusion about where to set stop losses, taking into account there's always a ratio when you trade these things.
Yeah, the pairs trade, for some reason, it's something people really do seem to struggle with. So we did this trade last week, a pairs trade between Pioneer Foods and ZED. And I'm going to go through it again and explain how it's not working at the moment, but there's a reason for that. But basically, what is a pairs trade? Well, it's a trade where you go simultaneously long and short two separate shares. They usually should be related. So things like Pioneer Foods and ZED is a good example, or Rand Merchant Bank and First Rand would be another good example. Shares that are very closely correlated and generally track each other quite closely, and for good reason. And every now and again, the ratios between those shares might move out of line slightly. And when those ratios move out of line, that's often when the opportunity comes, because you're invariably looking for some sort of a mean reversion type of trade.
That's essentially what you're trading, is the ratio.
That's exactly what you're trading. You're trading the ratio. So let's quickly unpack it and look at how we did it with Pioneer Foods and ZED, just so that it makes a little bit more sense. And then I'll try and explain it in a little bit more detail. Now, what you've got on the screen there at the moment is a chart with the share price of ZED and Pioneer Foods overlaid against each other. There's no particular scale here because obviously they trade at vastly different levels, but really that is just to illustrate the fact that the share prices do generally track each other very, very closely. And you can see the ZED share price is in blue and the Pioneer Foods share price is in yellow. And every now and again, you get these situations where the ratio opens up, and invariably it comes back together at some point. Now, we're in one of those situations at the moment where Pioneer Foods has moved a lot higher relative to ZED. And that shouldn't really happen, and I see this as a bit of an anomaly, which will probably correct itself ultimately. And if we think about why it should correct itself, well, remember, ZED is it's an investment holding company with assets in the food and food processing business. That's what ZED is. There are the constituents of what makes up ZED's market capitalization. And you can see by far and away the biggest chunk of what makes up ZED's market cap is its shareholding in Pioneer Foods. That accounts for more than 75% of ZED's market capitalization. And then you've got all those other assets there, Cape Span and Carp Agri and the like, Quantum Foods, etc. All that other stuff makes up the remaining 25% of the business of ZED. But it stands to reason, therefore, that the share prices of Pioneer Foods and ZED should track each other very, very closely, and usually they do. However, the ratio has gone out of line recently. And if we have a look at the graph in another way, this now is a plotting of the ratio between Pioneer Foods and ZED. And I know it looks like just a very squiggly line, but I'll explain what it means. That graph is derived by taking the share price of Pioneer Foods and dividing it by the corresponding share price historically of ZED. And then that figure is plotted on a graph. And that graph over there is 3 years' worth of history. And you can see very clearly that the ratio between the two shares generally has oscillated between 18 at the bottom. In other words, Pioneer Foods divided by ZED is 18 at the bottom of that ratio. And then at the top of that ratio, it's 22.5. So historically, for 3 years, and in fact before that, the ratio between Pioneer Foods and ZED has tracked that range. And historically, whenever it's got towards the top of that range, you can then say that Pioneer Foods is expensive relative to ZED, and you can then short Pioneer Foods and buy ZED. Alternatively, if it gets to the bottom of that range, then it means that Pioneer Foods is cheap relative to ZED, in which case you would then buy Pioneer Foods and sell ZED. And what's happened in the last month or so, you can see it there illustrated on the top right of that graph, is that this ratio has blown out completely. It's gone to a new high, which we haven't seen in many, many years. And that, to me, doesn't make sense. It shouldn't, because what it's saying to you is that Pioneer Foods is now trading very expensive relative to ZED, or alternatively, ZED is trading very, very cheap relative to Pioneer Foods. And because the two shares are so closely correlated, I mean, one is almost a mirror of the other, that ratio should come back into line at some point, and that's what we've tried to trade with this pairs trade.
I mean, how's it working out though? Because are we seeing any correction in ZED, because you've gone short ZED, you've bought Pioneer, so you've gone short Pioneer and bought ZED.
Yes.
Is it starting to move?
Well, we're actually on the wrong side of it at the moment,
okay.
and I'll unpack the actual the dynamics of the individual trades now. There's a reason why, and I didn't know this reason last week when we recorded the show, but there's a reason why Pioneer Foods has been so strong. And the reason is that it's been included into a number of the MSCI emerging market indices.
Okay.
All right, so there's obviously going to be tracker fund buying to chase Pioneer Foods ahead of that. And it looks highly likely that Pioneer Foods will also go into the top 40 when they do the September reweighting of the top 40 index. So now it suddenly makes more sense to me why Pioneer Foods has been so strong on a relative basis. But nevertheless, it still shouldn't really mean that the ratio moves out like this. Okay. Because at the end of the day, remember, 75% of ZED is Pioneer Foods. So ZED should move up in line with the strength in the Pioneer Foods share price. So this widening of that gap I see as a short-term phenomenon. It's most likely and most definitely driven by the fact that there's these reweightings coming, which has affected the Pioneer Foods share price. And I think once that is out of the way, so we're talking probably mid-September now, once that is out of the way, I would very much expect this ratio to move back into more normal territory. Now, what did we do? Well, last week we put the pairs trade on, and I went short of Pioneer Food with a notional value of 150,000 Rand. I did that at a price of 205 Rand and 20 cents on Pioneer Foods. So it meant that we shorted 731 CFDs of Pioneer Foods. Against that, I then went long of ZED, also with a nominal value of 150,000 Rand. The price then was 8 Rand 53, and the quantity therefore was 17,585 CFDs. Now that meant that the ratio between the two was 24.05. So you take the Pioneer Foods share price, 205 Rand 20, divide it by ZED at 8 Rand 53, and that gives you a ratio of 24.05. My stop loss is going to be if it moves out above 25, and I may even be a little bit flexible with that, but I'm going to monitor it carefully. And I would look for the ratio to come back down to about 21, where I would want to take profits. Now, the thing is, I've had a number of questions around this over the last week, which seems to suggest that people battle to grasp this. A couple of the questions were that they've been stopped out on the ZED leg of the trade, for example, or they've been stopped out on the Pioneer leg of the trade. Now, you don't put an individual stop loss on the stocks themselves here. Remember, what you're doing is you're effectively trading the ratio. So that 24.05, we want that ratio to come down. If it moves up, well, then we're out of the money on the trade. But you need to set your stop loss based on where the ratio goes. You can't put a stop loss on one of the individual stocks, because the likelihood is then you will get stopped out on one and not the other. And then your whole pairs trade is suddenly no longer a pairs trade. So that's very, very important. And the other thing is, somebody said to me, can you trade, like, is this ratio listed somewhere that you can trade it as a ratio? No, it isn't. You actually need to construct this trade yourself by doing the separate long and short legs of the different shares, like we've done here. So we've shorted Pioneer Foods, that's a trade. We've gone long of ZED, that's another trade. The two are married together by virtue of their relationship and the ratio between the two. But we don't put automatic stop losses on any of the individual stocks here. We're trading the ratio specifically, and that's what we've got to focus on.
Okay. Garth, okay, so to explain, and as you say, it does raise a few questions for viewers out there. I know you also want to revisit the put options structure, given where the market is at the moment, and it is looking a little bit peaky.
Yes, it is. We've got an interesting sort of setup on our market at the moment, and it's a bit weak. The momentum's been a bit weak, both locally and on some of the global markets as well. Not an easy trading environment to be in at the moment, and I guess that's also why we've been rather conservative and cautious on this show. We've got that pairs trade, and now we've got this option structure, which I'll discuss more. We did the option structure originally on the 7th of July on this show, but I'm going to revisit it today because it's at interesting levels now. But first of all, let's look at the bigger picture in terms of the top 40 index, and there you can see it. Now, this goes back over the last 2 years, this graph. What's quite interesting is notice that upward channel that's evident there. It joins the tops beautifully, and it joins all those lows beautifully. We do still have this head and shoulders pattern evident on the market that we've discussed at length on previous shows, and it is still valid. We need to keep an eye on this 45,000 sort of area, because if that starts to break to the downside, then it probably does spell further weakness for our market. So certainly worthwhile keeping an eye on that. And then the big question is, do we see our market potentially going back down towards the bottom of this bigger channel? And also that would correspond with the bottom of that smaller channel there, that dotted lines that I've introduced, which comes in around about 43,500 to 44,000, that sort of area. Would we be looking at the market potentially going down to that area? Now, if it does happen that we go down there, then we're quite well positioned for that. And the reason is because we put this option structure in place during July, as I mentioned.
And it has a September expiry, doesn't it?
Yes, it expires on the 3rd Thursday of September, which, if I'm not wrong, I think is the 21st of September, but I need to double check that date. Anyway, whatever the 3rd Thursday of September is, that's the date of the expiry. Let's quickly have a look at how we constructed this. So it was a put spread option structure over the top 40 future. So what you've got there on this diagram is, along the bottom of that chart, you've got all the levels of the top 40 index, and then on the left you've got profit and loss, profit above the line and loss below the line. I did 3 legs to this put option structure. So the first was that we went long of one contract of a 46,000 strike put option. I paid 11,624 Rand for that one option structure, which is all very good and well. And that thing, you can see I pay away the premium. That's hence why the green line is below the bottom of the profit line here. And then it starts to make money, and it will continue to make money the more the market falls, and it'll make money all the way to zero. But the market's not going to go to zero. We can't be that bearish, surely. So what I do is I then sell away some of the downside participation in order to actually create some premium income and effectively reduce the cost of that option structure that I've bought there. So what I did first of all was I sold one 44,000 strike put option, and the price there was 5,490 Rand. So in other words, I received that 5,490 Rand in as premium income. All right. And then, of course, that structure will start to lose money if the market starts to track below 44,000. But keep in mind, by that stage, we're already making money on our other 46,000 put. All right. Then again, I sold another out-the-money put option, this time a 42,000 strike put. The price that I received for that was 2,582 Rand. Again, that's premium income that I earn. So the net effect, if I sort of tidy it up a bit, is that yellow line. If I overlay all 3 of these option structures together, that yellow line is what we're looking at. And if we tidy it up further, that's how the payoff profile for this put spread option looks. So above 46,000, I've paid away a total premium of 3,552 Rand. That's gone. Goodbye. It's 1% of our capital. So it's not a lot that we're paying. If the market were to fall, and it were to fall into that profitable zone, the most profitable area for us is between 42,000 and 44,000. In that zone, we would make 16,448 Rand profit. All right, so you can see that the risk-to-reward ratio on this structure is about 5 to 1. Okay, and we'd only start to lose money if the market started to trade down below 40,000 odd.
Garth, I mean, going back to the chart of the top 40, that whole sort of head and shoulders pattern has kind of been working itself, and in relation to the top 40 index, that's, I guess, the payout profile.
Well, this is it. So, I mean, I just want to go back one slide. At the moment, this orange dotted line is indicating where we've been trading today. The market's been at 45,000 today, which means we've got a mark-to-market profit, theoretically, running of 5,448 Rand at the moment. If we take that and we overlay that payoff profile back onto the chart of the top 40 index, there you can see it illustrated in a different way. So we've got our September futures closeout expiry over there, 3rd Thursday of September. Now notice below 46,000 we start making money. Below 44,000 to 42,000 is where we make our most money. So yes, if this head and shoulders pattern was to play out and we were to see the market heading lower, or if the market was to head down towards the bottom of this bigger channel that we had identified, then we will certainly be very, very well positioned for any weakness in the market.
Garth, unfortunately, we've almost run out of time, but so what does the portfolio look like? Because it does appear that we're in the money on that option structure, especially with the market being quite weak at the moment. Yeah,
we are in the money. Look, our portfolio is sitting at just over 350,000 Rand now. So we start the year with 250,000. We're up 100,000 Rand for the year to date. And you can see all of our positions, recent positions there on that slide at the moment, showing the profit on the put spread and then the Pioneer Foods and ZED pairs trade as well.
Yeah, and so just keep a look at some of the stocks like Naspers. I know you wanted to talk about them, but just one last comment. Your next course is Bloemfontein. That's the last course date for the foreseeable future. Yeah, it's this weekend, so Friday and Saturday, the 21st and 22nd of August, I'll be down in Bloemfontein. Anybody that would like to attend, please email me, garth@traderscorner.co.za, and I'll send you all the details. Okay, Garth, we'll have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner was proudly brought to you by IG. Visit igmarkets.co.za to open a trading account today.